turn on the radio, Billy, just so you know. But I was telling everybody about how nice your voice is. People want to know if you can read the disclosure today. Just why don't you just read this these first two sentences for everybody.
Good afternoon, everyone. Derrick Oldensmith is an associated member of T3 Trading Group LLC, a SEC registered broker-dealer and member of FINRA and SIPC. All trades made by Derrick are placed through T3 Trading Group. Have a good day.
Thanks, Billy. Everyone's loving it. All right, guys. You heard the disclosure there, position disclosure. So we are good to go here with today's afternoon meeting. I love it. Oh boy, yeah, not great, right? Not great. The selling into the CPI today doesn't surprise me at all. I was kind of alluding to that. I think in the morning meeting today that was a realistic expectation for the market, especially as we were kind of gapping below 380 this morning. Things just did not look good to me. It's still a pretty big down day. We have another 2%er. So many 2%ers this year. 2% down on the SPYs, 2.2% down on the Qs. A ruthless 2.7% down in the IWM. Let's get a Bitcoin ETF percentage here. Let's throw that one in. BITO down 12.5% right now. Oof. Not good. Not good for the home team. Yeah, so, again, snap back to the morning meeting today. It was another day of kind of not really having a lot of conviction for the market. It was another day of less is more. It stinks, guys. I always want to be super excited for every trading session, but that's just not the reality of the situation. And knowing when to be able to take a step back from markets and you don't have as much of an advantage is so key. And I think that's how these last, honestly, couple of trading sessions have been. Even today with some downside action, some downside follow through. There were a couple of good shorts that got called out today, but I, for the most part, was just using today as an opportunity to catch up on some work that I'm behind on, because I really did not want to be doing a whole lot with the market or being aggressive with the market today. I just want to wait and see on the CPI. So CPI tomorrow should be a big one. This candle right here is the last CPI number, October 13th. You can see it's one of the most wide-ranging bars of the entire calendar year, and this is a calendar year that has been consistently marked by wide-ranging daily bars. So what will tomorrow give us? I have no idea what that number will be. I feel confident, though, that there is the potential of a really big move, and I think it's pretty straightforward on this one. A lot of times with some of these numbers, job numbers and things like that, where like is good news, bad news, right? Because a lot of the times, Cherry, I just saw your comment, Cherry. A lot of the times, good economic news has been treated poorly by the market because good economic news points towards an increase in inflation. And like I've been saying last, maybe a few days or a week or so, I think that we are beginning to approach a time where we're going to be seeing a little bit of a different type of market, a market where we are juggling the Fed pause that we are slowly leading towards, inflation potentially and hopefully coming down, juxtaposed with just how bad the economy actually becomes. So that's kind of the big thing that we're going to be paying attention to. We're already starting to see it. I just don't know what's going to be fully reflected in tomorrow's CPI number, but we're already starting to see the housing numbers, the housing price numbers, kind of begin to come down. So we'll see. We're seeing Upstart, right? The most interesting thing about Upstart's earnings, and it's interesting that it got brought back up, was really not that I'm trading Upstart or I'm involved in Upstart. It was the language on personal loan defaults increasing. That's happening at the same time as, again, housing prices are coming down. At the same time as just, you look at any of these stocks, all these stocks are now 80% plus, and now crypto is on its way to maybe zero. There's just got to be a wealth effect that's coming into play, and especially as you start to see these mega cap companies get hit, because maybe your wealthy uncle is not heavily involved in Bitcoin, he's not heavily involved in growth stocks that are down 80%, but he's probably got some Amazon or some Facebook or some Apple exposure, and these things have just been trading incredibly bad. We spent a lot of time talking about that recently, so I'm not going to get into it too much. Well, I guess flip side actually is how well the Dow has been trading. If you look at the Dow, it's actually really impressive where this Dow has been trading. Unfortunately, it does not really mirror the market. Look at that, above the 200-day, above a declining 200-day. I guess it kind of closed right at it. Compare that to the Qs versus its 200-day. Compare that to the IWM versus its 200-day. A little bit closer, but obviously well below it. SPYs versus its 200-day. So this last kind of bear market rally, I don't know. I've been disappointed in it, because I guess it just happened in a lot of the issuances that I don't focus on as much. Because if you're involved in any of these Dow issuances, if you're involved in Goldman Sachs, if you're involved in Caterpillar, if you're involved in Honeywell, things are actually looking pretty good for you. The move has been incredible, but this move has left the mega caps in the dust. So we'll see. The sell-off into the CPI number, them selling it off, it's not unexpected. Not only is it not unexpected, it's like what we usually see, right? Here was a day in front of a CPI number that we sold off. Was that this? No, I think it was this day, right? I guess we got bought up in front of that one. But I remember that this was a day in front of the Fed and in front of the CPI that we sold off in front of it. So it's not unusual at all for us to sell off in front of this number. Let's see how it goes. And again, like I was saying, it's not a case of us trying to figure out is good news bad news or is bad news good news. This is going to be very straightforward. If the number comes in under expectations, we will probably tear higher. And if the number comes in worse than expectations, it could be really bad. It could be really bad. And it's interesting because one of the things that I was kind of doing a little bit today, I was typing up some stocks as an exercise, is I was just looking at where things are in the marketplace compared to the last CPI. Because if you look at just the SPYs, which I have up right now, the SPYs are they're pretty far away from this low, right? We were below 350 in the SPYs at that low. I think we were at like 346 or something like that pre-market that day. So we're $25 above lows right now in the SPYs. There's a lot of downside room there. But then again, you look at these FANG stocks, Apple's trading at its low, Amazon, which looks atrocious, is well below its low. Its low looks like a blip in the radar compared to this recent sell-off. Microsoft battling that area. A lot of these names are near their CPI lows. So again, going to be just really interesting to see how the market trades. As far as individual names go, Facebook was a big focus for me this morning. I liquidated my position in it into the sub move. So that was, of all the oversold bounces that I was looking for, which was generally, I would describe it as generally a good trade, but a difficult trade. Facebook worked really well. Google worked okay. Microsoft really worked really well. Apple really did not work at all, or very minimally, and Amazon absolutely was the worst and did not work at all. This Amazon chart is mind-blowingly terrible. We just discussed, I think it was in yesterday's afternoon meeting, this bear flag pattern and the potential continuation. You got to move from 105 down to $88, right? We were just kind of roughly looking for a measured move on this bear flag, and I think that we said that this could work its way into the low 70s. So I thought that it was a day too early for Amazon to break down out of this pattern unless the market really helped, and well, the market helped. So Amazon really broke down out of the pattern and is the worst looking of them. It looks really bad. So Meta was a focus this morning. There was an okay opening trade and plug that failed. There was great momentum here on the break of plug and very low risk on the initial entry. I think I called out like a long through, I don't remember exactly what the price was. This was not one of my ideas. I think this was Paul's idea in the morning meeting. And it became my favorite idea from the morning meeting, even though it eventually failed. The risk on it when we called it out off the open was very, very low. I think it was less than 10 cents worth of risk, probably like 6-7 cents worth of risk. And it gave a sick move up to 1641 just to entirely V-top and break lows. Market obviously didn't help, but that was an incredible failure. Still, if you were super greedy, you should be break even in it. And if you're not super greedy, you should have made money in it. Another idea was this Chegg. It sounds like a few of you guys caught this, and this was also not my idea. This is why I love our team. One of you guys brought this up in the morning meeting. Really liked this pattern. I mentioned this is basically a bull flag pattern. When does that usually go? It usually goes right when the ADMA catches up to the base. And I also love when you get an inside bar right at the end of a consolidation pattern because it sets you up for continuation. That's exactly what we had here in this Chegg. Really, really solid. So that was a pretty good trade. Some other things I thought were just kind of worth watching. The trade desk. This is scary to me, how they gapped this thing up and then sold it off the way that they did. Just a really important stock in the advertising space. So, affects the way like a Snap does business or a Facebook does business or a Google does business. Trade desk absolutely toasted. OLPX got mentioned in the morning meeting, but didn't really give too much follow through. How did Roblox end? Yeah, Roblox we called the short out. This is a pretty good trade. We called out the short here on this bar. So if anybody took that and rode it lower, I mean, this is like a perfect downtrend that lasted all day. You could have taken this Roblox trade. It was a decent amount of risk for this type of stock, 60 cents risk. But if you took that inside 5 and down into that pattern there, you're looking at $4 of downside on that. So that was a pretty solid trade to the short side. Called out a market short early, which actually shook out and failed despite how weak the market was. But once this high broke, I didn't like longs in here. Actually, I think I called out this inside 5 and down also as a short. I think I said you could take this either way. So if you took that actually worked out really well. It's like the high of the day for the market. But like I said, I was just not looking to personally push it. I did not do a whole lot today outside of really aggressively managing meta off the open. Just in wait and see mode for tomorrow. Feel comfortable to slightly nervous personally going into the number. But it'll all be good. It'll all work out. So that's all I got for you guys. Again, it was a nothing day. I didn't do a whole lot. We wanted to be less aggressive. We did sell off into the number, and we'll see how the number goes. So I am happy to answer any questions. And we do got to be a little bit careful on this crypto for potential contagion on crypto into the equity market. I don't know. I do think that crypto being totally sold has an effect on the equity market. To what degree, I can't be sure. All assets are correlated. Anybody who's like, I want to be in Bitcoin because it's a hedge against the rest of the world, it's super correlated. It all is. As long as money exists and people are using actual fiat currencies to buy cryptocurrencies and need to pull that money out at certain points, these risk assets are always going to be correlated. The interesting thing I have thought for a while is actually how well crypto is held up, considering that a lot of the growth stocks continue to kind of trade down even after crypto started to base out. And in my mind, I kind of view these hyper speculative things as very similar to a lot of growth stocks, except that many of them, like Bitcoin, doesn't even produce anything. At least some of those growth stocks have a business plan that they're trying to put together. But yeah, so that is all I got. I'm happy to answer any questions. We got some time, so if anybody's got any questions, any broad questions, feel free to ask them. Or otherwise, we can do a short one. What do we got here after hours? We got Bumble. Bumble is smoked. I guess people are not interested in the things that happen when you use Bumble. APPS is up. APPS up 13% on its report. Yeah, Bumble's guidance is no good. APPS's numbers beat on EPS, beat on Rev. Guidance is a little bit better than expectations on earnings and a little light on revenue, but it's still trading up. We had Bros report. This Bros is, I think this sold off during the day, right? Is it up after the report? Yeah, they closed this thing at 29. It's up after the report right now. Bros. Wynn Resorts is out. Wynn is down. Not much. Not much from where it closed, actually. Oh, Rivian's out? I didn't realize Rivian was today. Yeah, we're getting a lot of these growth stocks. They're interesting. Rivian off 10% right now. Jeez, this company loses so much money. They beat on EPS and they beat on Rev. And they affirmed their vehicle production, and they're still down 9%. Wow. Or was that a during market hours move also? Oh, it was. Yeah, they wrecked a lot of these growth stocks during hours today. Rivian was down 10% into the report. This is actually trading up on the report. And I'm surprised. They seem like they beat pretty impressively, actually, on EPS and revenue. This company loses an insane amount of money, though. I'm surprised that people are willing to be involved in this thing. Will Disney have a similar move to Meta? So I didn't look at the Disney report super closely. I know that it wasn't great, but so I don't know what their costs look like. I mean, look, I think that Meta is a very specific circumstance related around to the amount of money that they're spending on the metaverse. So I think that Meta is going to be very unique to Meta. So I don't think that necessarily Disney is going to trade like Meta or anything is going to trade like Meta. It's trading on its own bad numbers. I think subscriber growth was down. I don't really trade Disney, so I didn't look at it super closely. But yeah, look at this, man. COVID low. We're getting close to, I said this the other day, like we're getting close to some of these COVID lows. I think there's a few stocks out there that are below their COVID lows, but like a company like Disney, getting close to COVID lows. Which in some ways it just makes this market sell-off so much worse than the actual COVID sell-off. Even though the COVID sell-off was very vicious, it was really short-lived. From Paul, I struggle with adding back on swings. Every time I do, I lose money. I bought back some shop, and then it stopped me out. I was upset, so I fought it a little bit. Well, that's never going to work out. I know I need to work on fighting stock. My question is, should I only be adding back on a daily new setup versus not setup, not versus the original stop? So I want to first define the difference between adding and adding back. Okay, adding back is taking back risk. Adding means that you're adding risk. So if you're adding back, you should never finish red in a trade that you add back. It needs to be physically impossible based on your game plan. Unless it's a swing trade and the swing trade gaps against you, it should be physically impossible. So adding versus adding back. You have 1,000 shares of stock on a breakout. You sell 500 shares to cover your risk. You're left with a 500 share core position. Your worst case scenario right now is that you are at a donut. Okay, you end the trade zero. You sold 50% of your position, it comes down and stops you out. Like that same classic example that I love to just kind of use because it's simple. You get a sick momentum move in your favor. The stock gets really extended. Maybe it was 10 cents risk initially. You're risking $100 in it, and now you are 50 cents in the money, and it just went straight vertical up. And you say, you know what? Really fast moving in a short period of time. It's very extended here. I'm just going to sell 100 shares. Because if the stock price corrects or even time corrects, if the stock price corrects, I can buy that stock back at a lower price and I can keep the difference. So again, just using a random example, just making it up. You bought 1,000 shares through $50, 10 cents worth of risk. You sell 500 shares, 10 cents in the money, $50.10. It rips up to 50-50. You sell another 100 shares. It pulls back to the ADMA. You buy that 100 shares back at $50.25. So you sold $50.50, 100 shares. You're buying it back at $50.25 just because it's back to that equilibrium area. The reason why you sold that extra piece is because it was extended. It's no longer extended. You want to take that stock back to see if it's able to give trend continuation from there. Let's assume in this circumstance that now the trade totally 100% fails. You're getting stopped out of it. How much money did you make on that trade? You have that same 500 shares where you'd be at zero. You'd be at zero if you just sold the 500 shares and comes down and failed. In this case, you sold the 500 shares, you sold another 100 shares at 50-50, you rebuy it at 50-25, and now you get stopped out at the original stop loss. You made $25 on the trade, right? So that's how you want to be able to add back. You add back in a circumstance of win-win, right? Because now in this trade that totally 100% fails, you make $25 in it while still having the full core position to be able to make money from in case it works. So what you see me do a lot is I'll have that 500 share core position. I sell that 100 shares at $50.50. I rebuy that 100 shares at $50.25. I sell it again at $50.50. So now maybe the thing continues to go sideways for the entire rest of the day. I will just continue to be bid 50-25 and then offer that 100 shares at 50-50, and I will make the 25-cent difference over and over and over again as many times as the stock will give it to me while it goes sideways. Then eventually the thing comes down and it fails. My trade, I'm getting stopped out of 500 shares, so that's a zero. It's a zero plus $25 for every single time I made that 25-cent difference. So if it was just once, I sold 50-50, I bought 50-25, I got stopped out. Instead of it being a zero, I made $25. If it's twice, I sold 50-50, I rebought 50-25, I sold 50-50, I rebought 50-25, I get stopped out, I made $50 on the trade while still having 500 shares and getting stopped out of the position. If it happened 4 times, I make $100 on the trade. Maybe it happens once, and I sell 50-50 the second time, and now it just continues to go. Okay, well, I don't have that piece of stock. It's not going to continue to pay me on the upside, but I still have 400 more shares. So I've got enough of a core position where the stock giving continuation, but mine no longer having that extra 100 shares is not necessarily the end of the world. With that type of strategy, and this is a lot of what I do, the more stock you have, the better it is. Because it gives you a lot more flexibility, right? Like here I'm using an example where you don't have a ton of stock. You had a 500 share core position. So if the stock runs without you now, you've got 20% less of your position for the bigger up move. So that the equation that you're trying to do in your head as much as possible when you're figuring out your game plan is how many times do I think that this thing can go sideways here where I sell and add back and sell and add back and sell and add back. How many times do I think I can do that versus the potential of missing out on continuation, right? Because if I'm able to do that, 3 times and put an extra $50 in my pocket that I wouldn't have been able to otherwise, and the stock breaks out without me, it has to go up 50 cents before my decision to sell that stock and work that range equals it kind of going up without me that extra 50 cents. So you're trying to figure out the math on how much money can I make by kind of working a range in a win-win situation versus how much less I make by not having it in that core position versus how much extra I'm putting in my pocket on a trade that eventually fails and stops you out. That's, again, with a 500 share position, a core position, in this circumstance where you would be losing 20% of your core position and missing out on that continuation. What if it's a 5,000 share position and you're doing it with 100 shares? And now it just continues to go without you, and you got 4,900 shares instead of 5,000 shares, but you were able to, be there to potentially work that over and over and over and over and over again. Now you're getting a lot more into what I do, where I'll have a core position and I'll be able to kind of work it and work it and work it and work it. And that, by the way, is sometimes why you'll see me in certain positions for so long, because what I'm doing in my math also. So now let's change the circumstance slightly a little bit. You've got this position on in this trade, and this can be, I don't want to overly complicate things for people who are newer and are trying to figure this out, but this is something that I do. You took the 1,000 shares through $50. You have 500 share core position. We're up to that portion of it, and it ranges. And let's say it ranges the entire day, whatever, and you 4 times sold 50-50, rebought 50-25, sold 50-50, rebought 50-25. You did it 4 times. You put $100 in your pocket, right? Well, if you've got 500 shares and the stock comes down now and is about to stop you out, you can get stopped out at your original stop loss and make $100 in the trade and still have the full core position. Or if you are willing to give back everything that you made on the trade, you can give it an extra 20 cents. You could actually lower your stop loss and then just still have a break-even price on it, right? So if you just did that 4 times and put an extra $100 in your pocket, and your core position is 500 shares, instead of your stop loss being at $49.90 and getting stopped out and making $100, you could lower your stop loss to $49.70, get stopped out at $49.70, and still be break even on the trade, but give yourself more room to be able to hold it. Now that is a little counter to something that I also always say, which is that your stop loss should be a stop loss for a reason, and your stop loss should be important to the market, not important to you. This is a case where you are using a stop loss that's important to you and not important to the market. But this is where you can potentially begin to get into a strategy that actually becomes more quantitative in nature and a little bit less technical in nature. And in a quantitative strategy like that, then it might make more sense to trade it kind of the way that I'm describing. So that's why I can use Snap as an example. Snap's been a really, really good one for me. I've been in the Snap for a while, implementing a similar strategy. I can't tell you when. I think I got in it somewhere in July. I think I was in it for most of July, and I think I pretty much liquidated the position into this up move in front of the earnings report, and then the earnings report came out and it was a disaster. And then I was like, oh, this is great. I'm going to take my position back that I sold here, but do it from here and kind of continue to do the same thing. And I've just had this core position in Snap where I've just worked it and 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 worked it for the entire quarter while it stayed in this range. Just putting that amount of money in my pocket and putting that amount of money in my pocket and putting that amount of money in my pocket. I got a little bit lucky on this earnings report because if you guys remember, it gave a very, very quick pop to $12.50 or 13 or something like that after the report, and I basically sold my entire position into that and then rebought it again, and I've been in Snap just continuing to do the exact same thing. So I don't know, maybe my spreadsheet tells me because I try to keep up. Yeah, so I haven't updated my spreadsheet in a little while. But I think that my break-even price in Snap, if I'm willing to give it all the way back to break-even, is under $7 somewhere. So stock's trading at $9.50. I'm up really good P&L in it, and I still have a position in it. and I'm working it kind of as I'm describing to you through a game plan, knowing that I could give this thing to, I don't know what the exact price is, maybe $6.50. That I can add back stock even below where I originally have stock from, all the way down to like $6.50. I can basically buy stock like every 10 cents all the way down to $6.50, and still only at that price do I actually become break even in it. So that's a lot of kind of game planning flexibility that you can begin to do when you have more tier sizing. But the entire concept of adding back versus adding is to be constantly and consistently doing it in a win-win situation. And then the question that you're asking yourself is, how much money can I make from a range around a core position versus how much money will I not make if the stock goes up a ton? Like you know, if I'm selling stock on the way up in Snap because I'm doing kind of what I'm describing, and I get this 2-day move that just happened here from $9.30 to $10.30, and I sell, I don't know, let's just make up a number, I sell 1,000 shares into that up move, and then this morning Snap is getting bought out by Google at $20 a share. Well, that's going to suck for me actually, because I have 1,000 less shares and it's trading at $10 higher. It's a very fast move to the upside. So the question is that you're trying to figure out, which is very difficult to be able to answer, is how much money can I make from selling and adding back and selling and adding back around a core position that I'm still holding versus how much money will I not make if it gives a very fast move to the upside and I have that much less of a core position. For example, what I said to you guys before, if I'm able to work the range 3 times, that's the equivalent of not having that stock for an additional 50-cent up move, right? At a 50-cent, if I lose that stock after being able to work that range I described to you, that 25-cent range 3 times, if I lose that stock at $50.50, I am break even at $51 in the scenario of holding the position for the entire time to 51 versus selling and buying back. That's where I'm break even. If it goes to 51.50, I'm down money on it. If it never gets above 51, then I make even more on it. If it never gets to 51 and eventually comes and stops me out, so like, which scenario can I go through where this is better, this is worse, and what's the probability of each? And then again, I always think that the probability of the worst scenario of the stock going up like too much, which is a really good problem to have, and you have a little bit less stock, is less painful the more size you had on the original core position versus how much that you actually sold. That's adding. Adding back means putting new risk on. That's adding back. Sorry, that's adding back. Adding is putting new risk on. Adding is, I bought the stock through $50, I got my 10 cents worth of risk, got a 500 share core position, it's making a bull flag, I'm buying 1,000 shares because of this bull flag and I'm putting a stop loss there, and then I'm looking for continuation, and that second trade fails and I lose $100 on it. And when you do that, you can't let the second trade negatively impact the first trade. It should be, trade number 1 is I'm set up to be break even. I'm taking trade number 2. I lose $100 in it. So I lost $100 in this trade. This other trade ends up failing. I'm break even in it. So that means I'm net down $100 total on the day in this symbol. That's fine also. What you can't allow yourself to do is take the 1,000 shares, have a 500 share core position, you sell 100 shares at 50-50, it drops down to 50-25, and you buy 200 shares. Because you're upset that you didn't have more stock to begin with or something like that. Usually it's something psychological, right? Now You took an extra, you sold 100 shares at 50.50, you're buying an extra 100 shares at 50.25. This trade just totally comes down and stops you out at 49.90. You're going to end up negative, if my math is correct, negative $10 on the trade. You just turned a winner into a loser. And again, now you can take all these numbers and make them potentially much bigger. Or and then you're like, oh my god, I can't believe I lost money on this trade. I was up so much when it was at 50.50, and then you fight the stock. That's also really, really bad. So this is all the type of stuff, and I'm always telling you guys, like, you know, and because it's a little hard because not everybody's account size is the same, and you know, guys in here have $1 million accounts, guys in here have you know like 5-figure accounts. Like it's you know, not one size fits all from a game planning perspective. So you want to sit down and play around with the numbers. Like, the reason why I was able to just go, I'm sure that some of you who are listening who are newer are like struggling to follow along a little bit with everything that I just said. That's fine. This is recorded. You can go back and watch the videotape and write it out and try to figure it out. But you know, the reason why I'm able to just do this in my head is because I do it in my head all day, every day, because I've been thinking about and developing and playing with game plans for just years and years and years and years, with, you know, much larger positions than 1,000 shares or a 500 share core position, and those, you know, more simpler numbers that we're doing in this exercise. So I hope that helps with your question, Paul. It's not saved in the portal. The afternoon meetings are recorded live on my YouTube. So please subscribe to my YouTube, which I am pulling up the link for you to be able to do that right now because I'm trying to build out this subscriber base a little bit. Mark beat me to it. Thank you. Appreciate that. From Zach. I got into plug late 1561. Okay. I don't love your price, but I wouldn't say it's the end of the world either. It took me a little while to get to my 1-to-1. See, and this is why execution is so important, right? The better your price is, the easier it is to get your risk covered. If you're early on stock versus chasing stock, it's always going to make it easier to get your risk covered. I think I called this out with like a very, very small amount of risk early on in the day. I could put in this low right away, and it was long versus 1537. I think you could have bought like 1542, and then it's just so easy to get your risk covered with good execution price. The worse the price, the more you chase, the more difficult, and the more this isn't how many ways bad execution is bad. And Zach, by the way, I'm not even saying that you have bad execution here. I would say your execution at 1561 is okay. It's not bad. It's not great. It's acceptable. But just using you as an example without even reading your full question here, so that we can all kind of learn. The more that you have to pay up, the less stock that you're taking for the same dollar risk. So if the trade really, really works, it means you're going to have even less stock. You're going to have less of a core position. You have less game planning options based on everything that we kind of just discussed on what you can potentially do. The more you pay up, the more difficult it is to get your risk covered. Because if you bought with 10 cents risk, you only need 10 cents of an additional move up. If you bought because you're later with 25 cents risk, then you need a 25 cent move up. It becomes significantly more difficult and lower probability of getting the break-even kick. That's going to make all the difference at the end of the day on your P&L. Execution is so important, and it's why we want to be very careful about chasing price if you missed the right price. And again, your execution is okay. I think that's the right word to describe it here. So you got your 1-to-1. Any tips to identifying a good buy-in, finding a stop, and executing before it runs from you? Yeah, sure. It's really just about having it on your radar at the right timing, right? So what I'm trying to do with my morning research process is I come up with all the names I'm planning on looking at. We do the morning meeting. You guys present your ideas. So plug today was not my idea. Plug was Paul's idea. And when he typed it up, or when he mentioned it, I was like, oh, I love it. It has earnings or an upgrade or something's going on here. I think that we could be looking at this thing through like 1530 or versus 1530 or something like that for continuation, or 1535, something like that. I honestly don't remember exactly what price we said in the morning meeting. But now I know, out of all of the ideas that got mentioned, plug is closest to the trigger entry. So sometimes I miss things because I've got to manage swing positions when the market opens. In this case, I had plug on my market maker at 9:30. Like, the moment the bell rings at 9:30, plug is on my market maker, because I know that of everything that's on my list, this is the one that's closest to the trigger entry point. So that's the one that's going to be on my market maker. The top 1, 2, or 3 that are closest to their trigger entry, to make sure that I'm not late on the things that are closest. Everything else that's a little bit further away, I have alerts out for. And depending on the price of the stock, my alert will be anywhere from 5 cents to 25 cents, usually away from the trigger entry. And then as soon as that alert goes up, I'm doing my best to be able to type that name up as fast as possible, take a look at it, see where it's trading versus where the trigger entry is supposed to be, and see if I want to be able to execute to kind of get in. So that's how you get that best execution, is by not being late. The later you type the stock up after your alert went off, the later you type the stock up after it triggered through the price, the later you're going to be, in the worse risk reward you're going to get on the trade. And if you totally missed the trigger entry, a lot of times you shouldn't even get in at all. So knowing what's closest as the market's opening, and then having a system of alerts out, I think is the way to do that. I hope that helps. From Steve, follow-up question on my rant earlier. I seem to remember you saying when you first started trading, you did a lot of day trading. I don't think I kept a position overnight my first few years. I assume because your account was small, it was, but it was also a different market environment. I also, at that time, I don't want to say I wasn't allowed to hold positions overnight, but it just wasn't done, and it was somewhat frowned upon. Like, all the traders on my team, like how we're a team, when I first got started, it was a team of day traders. No one kept positions overnight. That wasn't the game plan. It was all, aggressive tape, high volume trading that we were doing, racking up a lot of volume, which is why it's like, I get it, the market environment has changed, but sometimes when I talk to traders and see the volume that they do on an account that was the same size account as when I got started, I'm like, when I was a brand new trader, I was doing 20 times the volume that you're doing with the same account size, but different market environment. So a lot of that has to do with different market environments. I wasn't swing trading then; I was only day trading. It seems clear that once an account grows a bit, it's better to start swinging. I think that is true, regardless of account size, to do it from a win-win situation. Now, the stuff that I'm just describing, as I say that you can hold positions overnight in win-win situations for any account size, I will also say to you very broadly, I'm very confident having a bigger account and working with more money makes this business easier. For the reasons and the reason why is game planning, 100% game planning. If we both take the same trade and I take it with 10,000 shares and you take it with 1,000 shares and the trade just straight fails, I'm going to lose more money than you. But if the trade works to even any degree on a percentage basis of the risk that we put on, I am going to make more money than you. And that's because of the game planning flexibility that having a larger account and larger tier size actually affords. So anybody, I think, can keep positions overnight. If you're in a win-win situation, you want to do it to maximize reward. But at the same time, without a doubt, working with more money and working with more capital makes this business easier. It's not fair. It's a law of large numbers or something like that. It just is true. So you were better positioned to do what you explained about add backs and cash flow, etc., because you can trim your swings into strength. Do you agree with this? Yeah, so everything that I just described earlier was not stuff that I was doing as a newer trader. Again, I was specifically day trading. I did a lot of buying off support and even more so shorting off of resistance. So it would be counter trend like that, or it would still be kind of range based. And back then I had a system that I would work a lot, which I don't like. I don't like it now because it just doesn't work. It doesn't. What I did then doesn't work. But I can explain some basics of the game planning around it at least. I would not only look to, let's say, short up a resistance level, but I was always looking to trade off of size in the level 2. So it was very much level 2 focused. I'd be trading versus refreshing sellers, and I would be trading versus large offers in the book. And you don't even see those large orders come into the book anymore. The market makers, not the market makers, the algorithms in the market, there's less hand traders that are working orders. For probably good reason, because those hand traders didn't do a good job. I mean, just, hey, let me just throw a 250,000 shares on the offer at this price for everybody to see. We were front running those large orders, and we were shorting off resistance. And what I would do is I would usually have like a 2 to 4 tiered entry system, counter trend, and it would let's just say it's a $50 stock, and I wanted to go short versus $50. I would probably, I would usually short, I would do something like, I would short 400 shares at $49.87, so 13 cents risk, an additional 400 shares at $49.93. I guess this is going to be a 3-tiered system. An additional 400 shares at 40, or sometimes 800 shares at $49.97. So I'd have 3 entries of 400 shares, shorting at 13 cents risk, 7 cents risk, 3 cents risk. And then what I would do on the downside would be, if I got filled the first 400 shares at 13 cents risk, I'd be bid 200 shares, 13 cents in the money and 1-to-1. I'd be bid, another 100 shares, like at 2x that 13 cents risk. And then the last piece, I would throw like 50 cents out. And I was never holding for the really big move, like what I always preach to do now, hold some for the really big move. Never did that, but I was also almost exclusively doing this counter trend or in range based scenarios, where you always have a much lower probability of getting that really big move. But every once in a while, I remember looking like, wow, I was short that thing all the way up there, and it went all the way down here, and wow, I didn't hold any stock. Like I could have made. Imagine if you hold all that for such a big move. So, like a lot of that same game planning stuff, though, I was doing just in a different format and a different type of trading back then. And then you would reload. So if I shorted, the 400 shares at 13 cents risk and covered it at 200 at 13 cents reward, I would reshort that. So it basically would be like whatever the initial risk is that I'm putting on of 12 cents risk by an average of it'd be 1,200 shares at an average of 7 cents risk or so, whatever. Let's just call that $100 worth of risk. The math works out somewhere around that. I was going to take on that full $100 worth of risk no matter what, and then every time I was able to get some sort of covers on it, then I'd be putting kind of money into my pocket. But I would also have a system where I would reload less over time, because every time I get reloaded less, there'd be a lower probability of success of the trade working and a higher probability of a breakout occurring. So you would take, if I was risking $100 on the first 3-tiered entry, if it comes back up, I'd be set to risk $70 in the second 3-tier entry, $50 on the 3rd-tier entry, and then I would have a minimum amount of risk, maybe that $50, that I would just keep and keep and keep until the trade eventually either just works and I make whatever I make on it, or it stops me out, and I would just kind of work that over and over and over again. That's a lot of what I was doing then, but I would never keep anything overnight. If I had positions that were open because the trade was still ongoing, I would just liquidate into the close wherever it was trading. So yeah, I think that fully answers your question, because it has, in some ways, as I think about it, some of these game planning, cash flow principles that I kind of talk about, even with how I traded back then. But I don't really teach that type of trade anymore, because I tell you, it doesn't work, and that's why I don't do it. If it worked, I would be the first to be going back and doing it again. But you just can't. You don't see the size in the market anymore. And if you do, it almost is like a target for the market, as opposed to the market used to be like afraid of it. It would be like if you take it, the difference between size trading, and that's what we used to call it 12 years ago, versus size trading now, is back then, if the size was a magnet, it'd be like you're taking the magnets upside down so they're pushing each other away. Now, if the size is a magnet, it's like a magnet for the stock, where I feel like when you see size in the market, it like goes after it all the time. So it makes that trade entirely unsuccessful. Hemming, how to understand Tesla is keeping break key support when Musk is selling. If Musk stops, does the full? Well, Musk already did stop. I'm pretty sure Musk is done, right? Whatever he said was sold is sold, and that comes out, a little bit after the fact. So I'm pretty sure that's done. Does that mean that the stock is going to bounce back? I have no idea. I think that Tesla is an extremely overvalued stock, less so now at $176 than it was at $310. His selling reduces confidence in the stock from shareholders, and it adds to the amount of tradable shares that are out there. So he is doing material damage to the price of his stock. So he maybe starts the wave of selling, but it doesn't necessarily end it just because he stops. We know that markets work in feedback cycles. His selling can trigger more selling in the marketplace from other participants, and that could be a lot of what we're looking at. Man, I tried to short this Tesla so many times, and I gave up on it. It just, I used to do, honestly, a lot more short selling pre-COVID than I do post-COVID, which maybe has actually negatively impacted my year. I'm still happy. I'm actually very happy with how my 2022 is going based on the market environment, and I'm maybe a little bit scarred as with my short selling, just because like all of my biggest losses in my career, I think, are on the short side of the market, and they're in Tesla, they're in Roku. Took a nasty one in Palantir. Like they're all companies where my brain was like, this stock price is freaking ridiculous, and the technicals were not confirming my thesis, and I'm trying to work it, and it's so much like, to me, the long side of the market is much more comfortable for me, because I know that the most the stock can go down is to zero. And if you've ever been really short a stock that is squeezing, and it's happened to me on more occasions than I would like to remember at this point, like not too many, but like, anybody remember when I got stuck in Eastman Kodak? Is that freaking thing still a stock? Oh my god, this was like one of the scariest experiences in my entire trading career. It was this move, right? This was so scary. I still can't even see the top. How do I see the top? I can't even get to the top of this chart from this move. Yeah, $60, and it was, what you don't see is that it was halt after halt after halt after halt after halt. It was just like, I think I started shorting this thing at like $28 because I was like, this is ridiculous. And look, there's a signal, I'm going to go short. This is absurd. Eastman Kodak. Like, what are people going to go? I remember when I was a kid, like a little kid, and my mom would like go to the Eastman Kodak store to get her film developed. Like what are people going to start getting their film developed? And I was like short, I think, at like $28 on an actual trade. and the thing was going nuts, and I think I was in the money a little bit briefly, and then it was just moving so rapidly that it halted. It opened past my out. Now I think I added because I wanted to manage the position because I missed my stop loss, and then it halted, and then it gapped up again, and then it was like opening and halting like within like 3 seconds, over and over and over and over again. And next thing I know, stock's at $60. I'm down a very nice 5-figure number of P&L in this thing, and it's at $60 and finally began to top out there. And I think I was able to add. I still took a significant loss in it. I think I got out in either the low 40s or upper 30s after the thing was at 60. I think the low 40s for like a nasty low. And I knew that this thing was going to $10 again, or wherever it belongs. And it was just so scary because when you're in this thing and it's halting over and over again, it's at $60 and you're down a massive amount of money, and you know that the idea is right for sure. You know that the idea is right. This thing belongs at $10. I'm so confident in it. But what happens if the thing goes to 140 before it comes back down to 10? I could blow up my entire account, right? So that's what's so scary to me on the short side of the market. And again, I took this loss in Kodak, which I managed to make not awful, but I had a nasty one in Roku, which I just didn't believe in the company at all. I had a nasty one in Roku somewhere on one of the moves up. Tesla, I got stopped out like at this high, this split adjusted $300 into this move, and I was like, this move cannot last. This move cannot last. And stopped myself out like literally at the high for a nasty loss. Palantir. I said when Palantir IPO'd, short traders remember, this is a garbage company. It's probably worth $3 to $5 a share. It's probably worth $3 to $5 a share. And look, it's at $6 a share now. I was right. Stock went to $44 first. I stopped myself out of my short somewhere in the low 30s for a nasty loss. And I knew I was right, but it doesn't matter if I know that I'm right. So to me, it's like it's always that fear of, again, going back to that Kodak. Like, I know that eventually that this position is going to be right, but if I blow up my entire account before the thing is right, then then I got bigger problems, right? Because on the short side, the stock can go infinitely up. It can go infinitely up, and we've seen that even with some of these ludicrous. What was that crazy one that was like an IPO that was somehow related to Ameritrade or something like that? That went to like $10,000 or something like that, where we all knew it couldn't continue. But I told everybody here, was it HKD? Yeah, look at this. This is exactly what I'm talking about. This is why short selling is so dangerous. Like, Kodak went to 60 and went down to 40, and I got out at maybe 42, and then I was right and it went to 10. HKD, is anyone surprised to see HKD back at $16? No one's surprised to see this at and you could have been short this thing at $150, knowing that it's going to go to $16 and be 100% right. But it went to $2,555 first. If I'm long, I know that the worst thing that can happen, and it's crazy, and I don't want to hold stocks to zero. That's bad risk management. But I know that the worst thing that can happen is that it can go to zero. Like this snap, which has been so bad that I was describing my kind of cash flow game planning on this. Like, I have like a dream, the type of dream. I probably can't say it because of compliance. Heard the meeting, they wouldn't like the term. But I have like a dream of Like, what if I could create so much cash flow from Snap that my break-even price in it is $0 in it? Like, that excites me. I can't do that to the short side. I just can't do it. It's not possible, because it can go up like an HKD to wherever. So yeah, knowing sizing, risk management, game planning, that's all the most important stuff. And yeah, some good shorts out there. That coin, I appreciate you remembering that. I think my price in coin was $400. I got out at like 320 and thought I was a genius. $45. So yeah, I mean, that's probably why I have a little bit of less confidence on the short side of the market than the long side of the market, just because I know that even in these types of moves, I can make money to the long side in bear markets. But the moves like what we saw, which I knew were bubbles in 2020 and 2021, you got to be so. I mean, even AMD, it was a really, really good short for me. I did really well shorting AMD, not AMD, AMC. That first day was very scary. I was short too early, and I got bailed out a little bit the next morning when they did that secondary offering, and it came back down. There's another one, AMC at $70. Yeah, right. No way. But they can just keep going and going and going and going. So you got to be surgical on the short side on these stocks. Also reinforcing the danger of shorts is that generally squeezes are faster than bad drops, I think. Yeah, probably often, but not always if news hits. I did trade GameStop. Let me read what Steve said. More likely to halt and have the problem you mentioned. But yeah, we've certainly seen that on the upside. It's so scary when you're short. I had a couple really good trades actually in GameStop to the short side also, but I didn't hold them for as big as I held AMC. AMC was a really big winner for me on the short side, and I had a lot of conviction with it. I stuck with it the entire time. I worked this for cash flow to the short side for the entirety of it, and I basically caught this entire move. I was very heavy in this rebound area here in $60, and I think I got out somewhere. I think 20 was my target, and I got out somewhere above 20, ahead of my target, just because the move was fast. I wanted to book the profit. If you go through that experience, how do you go back to thinking, to right thinking after? How do you right your thinking after? Like where I've been caught on stuff like that and experienced that. It's hard, man. It's hard. It goes back to the mantra. It always goes back to the mantra. The mantra is, all I have to do to make money consistently in the long run trading is to do the right things consistently over time. So I tell myself all the time, almost every morning, all I have to do today to make money is just do the right things consistently. And when I do that, I don't make money every day. Lost money today, but I will make money in the long run. I'm extremely, extremely confident that I will make money in the long run if I just do the right things consistently over time. That's what all my data shows. Scrolling up here because I think I missed some stuff from Fabio. I saw some old YouTube videos by Mark Sperling, and I know he was like a mentor to you. So do you still talk to him? Does he still trade? We chat sometimes, yeah. He got out of trading. He is doing private equity deals. He's got a handful of stuff going on that he's working on, but he retired from the prop trading business. I think that in the craziness of 2020, he was dabbling a little bit on his own, but it wasn't something he was looking to get back to full time at this point. He had a very, very impressive trading career. From Mike Reed. I know it's late, so you don't need to answer. You've mentioned the market being innocent, guilty, and I want your general thoughts around that idea. Sure. So that's one of the ways that I like to just approach markets from a thought process. I find that it helps me to understand how I should be positioned in the marketplace. And by the way, that innocent until proven guilty, guilty until proven innocent is something I stole that. That's not my original idea. That's from Brian Shannon, who's a technical analyst that I really like and respect, and I really like his book that he has, for learning to understand technicals, technical analysis of multiple time frames. But it's a concept that I learned from him, from watching him, that he uses that I really liked. So, and you can have that on multiple time frames, but where I use that concept a lot is just with Maribozu candlesticks or news events. So like the news event comes out, right? We do this. We're going to be doing this tomorrow morning. The news event comes out. We're going to measure the reaction to the news event. Whatever that low is, let's say the news event is up. Whatever that starting low is, as long as the market is above that starting low, the market is innocent, and you're going to be better off being long than short. If it's below that, if we trade down right away, or let's say we trade up but then we lose it, the market lost its innocence. It's now guilty. You're generally going to be better off being short than long, or being flat, kind of being in cash, not doing anything because it gave a move and then, failed that move. Or the opposite is true. We get that opening downside move, the market's guilty until it can regain that high, that opening high, in which case it proves its innocence. And while it's guilty, you're going to be better off broadly being short than long. And the same thing applies when those Maribozu candlesticks just kind of come into the market, especially when they're volume confirmed. And it just helps me have a general thought process of, if I'm buying a guilty market, I'm fighting it, really. So I better be making sure I got other things in place, like the right degree of extension, the right signal, if I'm buying that market. If I'm buying a market that's innocent, I can be, a little less surgical on the entries, potentially, because I'm going to have a higher probability of it just kind of working in my favor. From Andrew, do you like NVO? I like the chart. Chart looks fantastic. What is it? Oh, this is. I know I've seen this stock before. Yeah, I think the chart looks fantastic. You got resistance here. Had a super strong day, regardless of what the market did. Or did it? Oh, is it up after hours? Or am I getting I'm getting a false print. This tail's not real. I have a false print here at 116.98. It actually closed at 114.17. So it's kind of a doji day for it. But yeah, the chart looks fantastic. Would you enter above 1580 or 1624? Am I looking at the right stock? NVO? I'm just looking at a stock that's $116. Unless you mean 1580 or 116.24. I guess that's what you mean, actually. I like it above. Today's high is going to be lower than yesterday's high. Yeah, I like it above yesterday's high. Clearing out the tail. I don't know the name well enough to know if this is a momentum name that you should wait for a clearing of highs to buy, or if it's not and you should look to build in versus a pivot. Your only focal point to build in versus a pivot is all the way down here. So in that case, I'd probably be a little bit more patient. CarMax above. Yeah, this looks good too. I like these base type patterns that develop resistance when they break above the resistance. I like that. So CarMax above. I would call it a range between $65.50 and $66. Yeah, that one, I don't even remember which day it was, honestly, the GameStop. And it was before the split. It was more expensive. I guess it was this day. I Probably was this day. I think I like shorted the top on that day. I think I remember that afternoon meeting telling you all that I got a little bit lucky. Just do the right things consistently over time. It's all we have to do, and it has nothing to do with it has everything to do with psychology. But like, that's all you got to do, right? It's just mechanics. Just do the mechanics right. Don't let your psychology interfere with game planning and mechanics. Just do that right consistently and across the board, and the results will be there. All right, everybody, have a great night. I'll see you tomorrow.